Hello and welcome. In this video, we're going to be discussing accounting estimation. When you read financial statements, you're going to see a whole range of numbers presented to you. These numbers look to be precise and exact. You think they're measurements of something real and tangible. However, accounting is a social science. It's not like physics where measurements can be exact. Accounting numbers presented in financial statements are often based on estimates and forecasts of the future. That means these numbers may actually be imprecise. They may just represent someone's best guess of what will happen in the future. When conducting financial statement analysis, it's really important to understand how the financial statements are prepared and the choices that were made in creating the estimates that you see. In this video, we're going to go through the balance sheet and some of the simple accounting choices that are available in estimating key numbers such as accounts receivable, inventory, and property, plant, and equipment. Major accounting regulators allow accountants to choose how to record transactions in different ways. That is, accountants are given choices. They're given the choice to record the same transaction in multiple different ways in the hope that they choose the way that best represents the true economic activity the business has undertaken. However, it presents a problem that sometimes the accountant may wish to obscure the true picture of the business. This is called earnings management. We're going to talk about accounting estimation because it's something that's really important to understand when you are then doing financial statement analysis to understand that there could be variation behind the numbers that you see. Accounting figures are often based on estimations or forecasts of the future. And that's okay because we want our financial statements to present useful information for investors. However, the problem is those forecasts or estimations may be inaccurate as well, so it may obscure information. Understanding this balance is really important. We're going to have a look at some balance sheet estimation choices. Now, accounting for the profit and loss statement, assets, liabilities, equity, there's all sorts of accounting rules and regulations that accountants have to follow. We're not going to try and make you experts on accounting regulation in this short video. We're just going to look at some of the examples when we look at how assets are measured to see where the choices can lead to very different reported numbers. I'm going to have a look at accounts receivable, inventories, and property, plant, and equipment accounting very quickly to show you some of these choices. Let's start by analyzing accounts receivable. If a business buys inventory for $2 per unit and sells the product for $5, and they made sales to 100 different customers, on credit, where the customer is given 30 days to pay the invoice, then we're going to have a transaction that creates accounts receivable. In creating the journal entry for this transaction, we would have sales revenue increase by $500 and would have accounts receivable, which is an asset, increased by $500. It means that these customers owe you $500. We would also record a cost of goods sold expense on the profit and loss statement of $200, and our inventory asset would decrease by $200 as well. So accounts receivable is an asset, and from this transaction, you're owed $500. So you've got this accounts receivable asset of $500, 100 customers owing you $5 each. However, we know in reality that sometimes customers will be unable to pay you back. They may get into financial difficulties and go bankrupt. They may go to jail, pass away. There's all sorts of reasons why customers may not be able to pay you their money back. So what the accountants have to do is recognize this in the financial statements. So in this example, I'm going to estimate that 2% of my customers are unable to pay me back. That means 2 customers who owe me $5 each or $10 in total, I may not get paid back. Here's how I would account for this uncertainty on my balance sheet and profit and loss statement. On my balance sheet, I've got the accounts receivable asset worth $500. But if I truly believe that I'm not going to receive $10 of that, then it's not truthful or honest to report that I'm owed $500. So what I'm going to do is I'm going to create a contra account called allowance for bad debt. And I'm going to record a $10 value in this contra account. I'm then going to record my net accounts receivable of $490. This communicates to the reader of the financial statement that in total I am owed $500, but due to my best estimations, I think that $10 will not be paid to me, so I actually expect to receive $490 in the future. Then I'm going to look at the profit and loss statement. The profit and loss statement will record the revenue of $500 from the sales I've made, the cost of goods sold expense of $200, but we're also going to record what's called a bad debt expense. If I think two of my customers are not actually going to pay me the $10 they owe me, and I've already recorded it as a revenue, I need to record this bad debt expense. Of that $500 of sales, $10 of that will be a cost of credit or bad debt expense. So here, my accounts receivable have been estimated. I, the business owner or the accountant, chose the 2% level. I could choose 3%, 10%, 50%, or 0%. And all of these choices are available to me under the accounting regulations. The aim is that I make my best guess to provide the highest quality information to the readers of the financial statement. The risk is I use my estimations to make my financial statements look better. If I estimated only 1% of customers are not going to pay me back, my bad debt expense would be only $5, and I'd report a higher profit of $295. So these estimations lead to changes in your asset values and your profit values. We need to understand the choices available because they may be manipulated to obscure information from us. Another key asset on the balance sheet is inventory. Inventory is the tangible asset that businesses plan to sell in their normal course of business. And it's recorded at its acquisition cost or its historic cost. So when you buy the inventory for $100, you put it on your balance sheet valued at $100. However, that value may go out of date. There's a whole range of reasons why the inventory value may change over time. There might be price changes in the inventory. It might become obsolete, out of fashion. It could get damaged in a warehouse or store, or customers may actually steal your inventory and the value of the inventory decreases without you necessarily knowing it got stolen. So the value of inventory on your balance sheet could change through time for a whole range of reasons not related to actually selling your inventory. One of the most common inventory estimation techniques is due to the fact that often businesses don't know the price of the inventory they've sold. So here we've got a nice photo of a petrol station. A petrol station, in this case, has its reservoir refilled every 2 days. On the Monday, it gets filled up and they paid $1 per litre for the petrol. On Wednesday, they filled up the reservoir and they paid $1.10 per litre. And on the Friday, at the end of the week, they only paid 95 cents per litre to fill up the reservoir. Within that reservoir, all the petrol is mixing together. So when a customer comes along on Saturday and fills up their petrol tank, the business doesn't know the price of the inventory that they actually sold. Did they sell petrol that they'd purchased on Monday, Wednesday, or Friday? So they have to make a guess. They have to guess at which price they sold their inventory. The accounting regulation gives the business owner multiple different ways of recording this cost of goods sold and decreasing inventory from the sale. First, they're allowed to choose a method called first in, first out. That would make the assumption that whichever inventory you purchased first is sold first. So in this case, the petrol that was purchased at $1 per litre is sold to the customer who's coming on Saturday, our first customer. Alternatively, we could use last in, first out, which would say whichever petrol was filled up last gets sold first. So we'd assume the customer paid 95 cents per litre for this particular purchase, or they could use an averaging approach. Now, different regulations around the world allow different methodologies. For example, last in, first out is allowed in the US, but is not allowed in international financial reporting standards. Accountants are allowed choice in how they record transactions. That choice should be used to convey the most accurate information possible. However, sometimes we just have to guess. We don't know what petrol we sold. It was all mixed into the reservoir together. We just have to provide our best guess or some sort of estimation method. So when we see our cost of goods sold expense and our inventory balance for the petrol station, we know it was estimated and there will be some level of estimation error. Next up, we want to consider property, plant and equipment, or more broadly, non-current assets. When non-current assets are purchased, the business will record it on the balance sheet at historic acquisition cost. Accountants then have to calculate what's called depreciation. And depreciation is the expense that is incurred as you use up these non-current assets over their useful life. To calculate depreciation, accountants need to know the cost of the asset, its useful life, its estimated residual value, and they get to choose one of multiple different depreciation methodologies. If our business bought a building for $20 million and the company estimates the building will last for 30 years and at the end of the 30 years be worth $1 million in salvage value, then we could use the straight line method of depreciation to calculate what's called depreciation expense. That is an estimate of the value of the building that has been used up each year. So in this case, the depreciation expense would be $633,000 per year. We would take the $20 million purchase price. We would minus off the $1 million residual value, and that would be called the depreciable amount, and would divide that through by the 30 years we think the business will have the asset for. Depreciation expense is recorded on the profit and loss statement, while accumulated depreciation decreases the value of the building we purchased on the balance sheet. Now you can see from these estimates, the building might not last 30 years. It might last 20 years or 50 years. Depending on what estimation we make, the expense that we have will change our reported profit, and the accumulated depreciation that we record will change our asset value as well. Again, we conclude with the fact that for each item on the balance sheet, for each asset we look at, there is choice in the accounting regulation, and how those numbers are created depends on the estimations made by the accountant.